Almost every working Australian holds life and TPD insurance right now, whether they know it or not. For most people, it sits quietly inside their super fund, with premiums skimmed off the balance automatically. The alternative is buying cover outside super, paid from your own bank account. The first feels invisible and cheap. The second feels like another bill, but cheap and good are not the same thing. And the gap between these two choices can run into hundreds of thousands of dollars at exactly the moment you need the money most. Let us settle which one actually wins and when. Here is why this matters. According to APRA and ASIC 2023 claims data, the average total and permanent disability payout through a retail policy outside super is around $643,000 versus just $143,000 for default group cover inside super. That is roughly 4.5 times more cover when you can no longer work. Life insurance shows the same pattern. About $509,000 outside super versus $135,000 inside per the same APRA and ASIC 2023 figures. And the premiums you pay inside super are not free either. A 30-year-old paying $400 a year in premiums from their super rather than from after-tax pay ends up with around $26,000 less at age 67, assuming a 6.5% net return purely from lost compounding. So you can be both underinsured and out of pocket at the same time. At a glance, the two work in fundamentally different ways. Inside super, the trustee owns the policy, premiums come out of your balance, and cover is often a default you never chose. ASIC Money Smart notes this is funded indirectly by contributions taxed at just 15%, which is why it feels cheap. Outside super, you own the policy directly. You pick the cover amount and type, and you pay from after-tax income. The trade is convenience and apparent cost on one side against control, payout size, and tax treatment on the other. Keep that framing in mind because almost every difference flows from it. Inside super is the path of least resistance, and for some people that is a genuine virtue. Most Australians get default life and TPD cover automatically, often without any medical questions, which is gold for someone with a pre-existing condition who might otherwise be declined. And the tax efficiency is real. ASIC Money Smart notes premiums are effectively funded from contributions taxed at 15% versus a marginal rate that can reach 45% plus the Medicare levy outside super. For a young, healthy, cash-strapped worker with no dependents, baseline inside super cover is a sensible, low-effort starting point. The trouble starts when people assume the default is enough, because it rarely is. The clearest case for inside super is the funding mechanics. Group cover is bought in bulk by the fund, which can keep headline premiums low, and because the money comes from contributions taxed at 15% rather than after-tax pay taxed at up to 45% plus Medicare, the effective cost can be meaningfully cheaper. According to ASIC Money Smart, for a higher earner, paying premiums with pre-tax dollars is genuinely efficient, and nothing ever lands in your household budget. So the cover simply persists. The risk is that this same invisibility is exactly what lets the cost and the underinsurance go unnoticed for decades. Now the catch, and it is a big one. APRA and ASIC 2023 data show average group TPD payouts of just $143,000 versus $643,000 through retail policies, leaving relying members around $500,000 short. Second, those invisible premiums compound away. $400 a year from a 30-year-old costs about $26,000 by age 67 at a 6.5% net return. Third, when you actually claim a TPD benefit paid through super can be a taxable super lump sum. MetLife explains that under preservation age, the taxable component can be hit by up to 22%. On a $250,000 taxable component, that is around $55,000 in tax, you would not pay outside super. Convenient, but costly when it counts. Outside super flips the model. You decide what you need and you buy exactly that. The payouts reflect it. APRA and ASIC 2023 data show retail life cover averaging $509,000 and TPD $643,000, multiples of the group figures. You also unlock cover types super simply does not offer. Trauma or critical illness insurance is generally unavailable inside super per ASIC MoneySmart, yet can be vital for someone surviving cancer or a heart attack. This is the option for people with a mortgage, kids, or a partner depending on their income. The price of all that control is that the premiums come from your own after-tax pay, a visible, ongoing cost that demands a deliberate decision. The strongest argument for going outside is what actually hits the bank account. MetLife notes that a successful TPD payout held outside super is generally not taxed, and it is paid directly to the policy owner or nominated beneficiary. Compare that to inside super, where the insurer pays the trustee, who must then apply super law conditions of release before any money reaches you, slower and potentially taxed. On a $300,000 TPD benefit, outside super delivers the full $300,000 net. Inside super, under preservation age, tax can carve out around $55,000. You can also lock in stronger own occupation definitions that are easier to claim than the restrictive SIS-aligned definitions inside super per industry guidance. Outside super is not free of downsides. The premiums land in your household budget every month. And unlike income protection, TPD and life premiums bought personally are generally not tax deductible per MetLife. There is no 15% contributions tax shortcut quietly subsidising the cost. And because you fund it from your own pocket, missing payments can lapse the policy. There is no super balance silently topping it up. For someone with tight cash flow, that visible cost is a real barrier, and it is precisely why so many people default to the inside super option even when it leaves them underinsured. Let us score the first 4 criteria. On premium funding, inside super wins. ASIC MoneySmart confirms it draws on contributions taxed at just 15%. On cash flow impact, inside super wins again because nothing touches your take-home pay. But on payout size, the picture flips hard. APRA and ASIC 2023 data show average life payouts of around $135,000 inside super against $509,000 outside, and TPD of $143,000 against $643,000. So inside super takes the convenience rounds, while outside super takes the rounds that decide whether your family is actually protected. 2-all so far. Now, criteria 5 through 7. On tax at claim, outside super wins clearly. MetLife notes super TPD benefits can be taxed up to 22% under preservation age, while outside super payouts are generally tax-free. On speed of access, outside super wins again. It pays directly to you or your beneficiary, whereas inside super, the trustee must satisfy super law conditions of release first. And on cover types, outside super offers trauma or critical illness insurance that ASIC MoneySmart confirms is generally unavailable inside super. Outside super sweeps the quality rounds 3-0. Tally it up. Inside super won 2 rounds. Premium funding and cash flow impact, both about cost and convenience. Outside super won 5. Payout size on both life and TPD, tax at claim, speed of access, and breadth of cover types. On rounds alone, outside super is the clear points winner. But comparison videos that stop at the scoreboard miss the real insight. This is not actually an either-or fight. The smart answer combines them, and there is one number that tells most people exactly how to split. Here is the number that decides it for most people. Your age, with about 50 as the line. ASIC MoneySmart guidance and retail quoting suggest that if you are healthy and under roughly 50, a retail policy for the same sum insured is often not dramatically more expensive than group cover money off, especially once you account for the compounding you lose to inside super premiums, which can reach around $26,000 by retirement on just $400 a year. Under 50 and healthy, outside super cover is very affordable and worth loading up. Older, or with health issues that make underwriting hard, the guaranteed acceptance and tax efficiency of inside super carry far more weight. Age is the swing factor. So who wins? Honestly, it depends. But not in a wishy-washy way. There is a clear rule. For the young, healthy, single worker on a tight budget, keep your baseline life and TPD inside super, fund it with cheap 15% tax dollars, and move on. For anyone with dependents, a mortgage, or a serious need for adequate cover, Keep a baseline inside super, then add top-up TPD and life outside super, where APRA and ASIC 2023 data show payouts averaging $643,000 and $509,000, and where MetLife confirms benefits are generally tax-free and paid directly. If you have health conditions making retail underwriting hard, lean more heavily on inside super cover you can actually get. The losing move for almost everyone is the same. Accepting the default inside super and assuming $143,000 of TPD is enough. It usually leaves a $500,000 hole. Here is the decision guide. Choose inside super if you are young, healthy, budget constrained or hard to underwrite, and you only need baseline cover. Choose outside super if you have dependents, debt, want tax-free payouts paid directly, or need trauma cover super cannot offer. Choose the blend, which suits most working families, by keeping cheap baseline life and TPD inside super, then adding outside super top-ups to reach an adequate sum insured, generally tax-free, per MetLife. Whatever you pick, log into your fund, find the insurance tab, and read your actual cover amounts and premiums in dollars. And if you salary sacrifice to fund extra premiums, check your concessional contributions cap with the ATO first so you do not breach it. The fine print here is simple. Insurance inside super is not free, and the default amount is almost never enough. Spend 10 minutes today logging into your fund, find your life, TPD and income protection figures, and ask whether $143,000 of average TPD cover would really protect the people who depend on you. If it would not, that is your signal to look at a top-up outside super. Subscribe for more breakdowns that turn the boring fine print into decisions worth real money. This has been The Fine Print. General information only, not financial advice.